This week on Wealth Track, great investor Bill Miller has reached the highest performance peaks, fallen to the depths, and climbed back up again. Where is Legg Mason's legendary money manager investing now? A television exclusive with Bill Miller is next on Consuelo Mac Wealth Track. You are known as a financial thought leader and a creative thinker, and I know you stress continual learning here at Legg Mason. So what did you learn from the financial crisis and its aftermath? What were some of the major lessons that you have now taught the younger people who work with you?
Well, first of all, if something, as somebody said, if it can't be ruled out, it ought to be ruled in. And so one of the things that I did incorrectly was kind of rule out that we would have the markets would actually discount a new Great Depression or Depression scenario. I thought we have pretty robust strategies for dealing with market stress and tested them pretty well over the decades. But I explicitly said we can take that one off the table. Anything in the post-war period is fair game. Wars, Watergate, constitutional crises, inverted yield curves, double-digit inflation, crashes like '87. But a depression, that kind of scenario, that's not something we really have to think about. So clearly that was wrong. That was a big mistake. And I think the root of the mistake was in not understanding, I think, how policy can collide with economics to create cascading scenario. So as bad as the housing so-called bubble was, and I guess it was a bubble, as bad as that was, I think a lot of the policies that were undertaken in the early stages of this until the Lehman collapse exacerbated the problem, and I think that's something that we have to pay a lot more attention to, is the role of policy.
You mentioned earlier that you are actually looking now at higher quality, that U.S. big cap stocks, that there's value there. So you're moving up the quality spectrum again. Well, right?
We're doing it now for a different reason, which is that so small and mid cap continue to beat large cap, and my colleague Chuck Royce, we own Royce, the small cap specialist. I mean, Chuck's, I think, assets have gone back to their highs, and so the 10-year period that just ended, his funds, which are small cap funds, were up 10% a year on average, and big cap was down 0.2% a year on average. And so I think now, 10 years ago, small cap was really cheap and big cap was really expensive. Now, small cap isn't expensive because we're still in the early stages of recovery, but big cap is very cheap. And I think so you can now get much higher quality and don't have to pay for it. And I think that's where the best excess returns are going to be over the next 5 to 10 years, certainly. The next 5 to 10 months, I don't know, but 5 to 10 years in the large cap U.S.
Right, and I know that in the value trust at any rate, your average holding period is what, 4 to 5 years. So what are a couple of the specific holdings that you have that you think represent exceptional value over the next couple of years? Next 4 to 5 years.
One of my favorites in this whole thing is IBM, and I take IBM because I think it's representative not only of big cap quality but of the market as a whole, which is why I'm optimistic about the market. I mean, people can argue about what are earnings going to be this year, what are going to be next year, what multiple should you put on it, what's the right level for the S&P to sell at, that kind of thing. And to me, those are interesting exercises. But unless you're buying an index fund, you're actually buying individual securities. And with IBM, which just reported a couple days ago, again, record earnings for IBM, record margins for IBM. They raised guidance again. Very rare for them to do that, by the way, early in the year. But the reason IBM is so fascinating is that it's been around 100 years. And so there's all kinds of data on IBM if you're quantitatively oriented. How's it valued during recessions? How's it valued during growth phases? How's it valued when they have a new product cycle? All of that kind of, how's it valued when interest rates are low? How's it valued when inflation's rising? So you can manipulate the data on IBM and try and get a sense of how it's valued. Second, IBM is covered by everybody that covers that type of thing. So there's lots of people looking at it and trying to figure it out and trying to understand it. Third, the thing that's perhaps even more interesting about IBM is they're very transparent. They tell you their long-term economic model of the business. They give you detailed guidance as to growth rates and margins and cash flows. And the upshot of all of this is that there's very little dispute about what IBM is going to earn. And so if any stock should be efficiently priced in the market, it ought to be IBM. And yet IBM, for the last 5 years, has grown its operating earnings per share 15% a year. It's grown its dividend over 20% a year. It's bought back stock every single year, so shares outstanding have fallen. It's maintained a fortress balance sheet during that time. And through the worst recession since the Great Depression, it's continued to have record earnings and either record or near record margins. So my view is if it can grow that way during a terrible time, what's it going to do when things get better? And the answer is it'll do at least that well. Yet you can buy IBM today at 11.5 times consensus earnings this year and 10.5 times consensus earnings next year. And you can put it in any model you want, and it's going to show that quantitative models show IBM's worth 30 to 50% more minimally than where it's trading. Yet nobody seems to care. And why don't they care? Because it hasn't gone up for 10 years. Same thing with Walmart, it hasn't gone up for 10 years. Same thing with Microsoft. And all those companies, Walmart's 12 times next. Microsoft is about 13.5 times next. So that's where you can get exceptional quality, certainly with IBM and with Microsoft and with Walmart, exceptional growth opportunities in emerging markets around the world at much cheaper prices than you have to pay if you go to those markets where the risk is higher.